Hello, everyone. Today we're learning the basics of the commodities market. Commodities are natural resources we pull from the earth: oil, gold, copper. Just as a body needs blood, bone, and oxygen, an economy needs these inputs to move. When oil runs short, shipping and heating stall. When copper runs short, construction and electronics slow down. Like the WTI daily chart on your screen, commodity prices honestly reflect the world economy, inflation, and interest rate shifts. When growth is strong, commodity prices tend to rise. When growth weakens, they fall. In the U.S., when crude jumps $5 a barrel, gasoline at the pump, heating oil, and utility bills often follow within weeks. Historically, Middle East conflicts and supply shocks have pushed U.S. consumer prices higher a couple of months later more than once. Today we'll cover three signals: oil as the energy signal, gold as the fear signal, and copper as the growth signal. Understand those three, and you can read the pulse of the global economy. Look at the Brent weekly chart on your screen. Crude has two exchange benchmarks. WTI is the U.S. Texas benchmark. Brent is the North Sea benchmark. Think of WTI as landlocked oil priced at U.S. storage hubs, and Brent as seaborne oil that moves by tanker. U.S. pump prices track WTI closely. Global and European seaborne cargoes lean more toward Brent. Brent is usually $1 to $4 a barrel above WTI, but in geopolitical crises that spread has blown out toward $15. During the 2003 Iraq War, the spread hit about $12. In the 2020 COVID supply chaos, it briefly inverted. If you're studying oil from a U.S. or global desk, keep both on your watch list: WTI for domestic gasoline and heating, Brent for the seaborne world price. Historically, U.S. energy costs tend to follow crude moves with a lag of a few weeks, though policy shocks and sudden spikes can break that pattern. On TradingView, the symbols are NYMEX, CL1, for WTI futures, and TVC, UCOIL for the Brent index. Your broker may also show cash or continuous prices in real time. Look at the gold daily chart on your screen. Gold pays no interest and no dividend. So why is it expensive? Because in anxious times, it is often treated as the safest store of value. In the textbook, gold and the real interest rate minus inflation, move in opposite directions. When real rates fall, gold tends to rise. When real rates rise, gold tends to fall. 이그잼플 2% R3% 엔드 인플레이션 2.5%. 파워킹 케이스의 더 뱅크 스틸 루지즈 퍼처싱 파워. 리얼 레이 3% 마이너스 5% 마이너스 2%. Physical gold looks more attractive, so its price tends to rise. Flip it. Rates at 7%, inflation at 2%, cash and treasuries win, gold demand cools, and the price tends to fall. The Fed's rate path is a big part of that math. Historically, most gold surges were uncertainty signals. The 2008 financial crisis, COVID in 2020, the Russia-Ukraine war in 2022. In practice, rates, dollar strength, and bond supply all move together too. Practical tip: check it on the chart yourself. When gold spikes, does the U.S. 10-year yield, TVC, U.S. 10Y, fall at the same time? If gold is falling while yields rise, investors may be rotating back into stocks and bonds, including the S&P 500 complex. Look at the copper, COMEX, HG1, weekly chart on your screen. Copper goes into construction, cars, electronics, and power grids. That's why traders call it Dr. Copper, a diagnostic tool for the economy's health. Dr. Copper diagnoses the cycle. When growth is humming, factories run, and building ramps up, copper demand jumps and prices rise. When growth slows, plants cut output and projects stall, and copper prices can plunge. Historically, sharp copper drops flagged worsening growth. The 2008 crisis, the 2020 COVID shock, the 2022 slowdown. But when China demand or big policy shifts flip suddenly, that signal can weaken, so stay alert. As of 2026, the AI boom and the energy transition, solar, wind, EVs, are creating fresh copper demand. Those industries can show patterns different from old-line industry. Still, if China's growth shifts, total demand can turn quickly. Practical signal. Check it on the chart. If copper is crashing while gold, TVC, gold, is surging, investors may be preparing for a weaker growth scenario. That is often when people lean toward defensive stocks and bonds. Look at the NYMEX, CL1, front month WTI, daily chart on your screen. Futures have expiries, like delivery in 3 months. So if you want to stay long, you must roll into a new contract every month. When the curve slopes up to the right, near contract cheaper than far contracts, that is Contango, it usually signals ample future supply, a normal market. Example, if the front month is $60, next month $62, and 3 months out $65, that is Contango. When the curve slopes down, near contract richer than far contracts, that is backwardation, a signal of spot scarcity. Historically, it showed up in the 2008 energy crunch, the 2020 oil shock, and the 2022 Russia-Ukraine war. When Contango is deep, big price gaps, holding a futures Vistippa for a long time can rack up roll loss of about 1 to 2% a month. To avoid that, investors often prefer physical bullion or physically backed S, such as GLD or IU. As an investor, glance at the futures curve once in a while. On the chart, you can tell Contango from backwardation, and the depth of the curve helps you decide between spot and futures. Look at the gold weekly chart on your screen. A supercycle is a multi-year bull run that can last 8 to 30 years. One ran from about 2000 to 2011 during China's urbanization boom. Gold rose from roughly $260 to about $1,900. Many analysts argue a new supercycle could begin around 2026. The case rests on historical cycle patterns plus the 4 structural drivers below, but it is only one scenario. China growth and policy shifts can rewrite the script entirely. First, the energy transition, solar, wind, EVs, is surging demand for copper, nickel, and lithium. More rooftop solar in every city, EV sales climbing tens of % a year. Second, AI and data centers lift copper and gold demand for semiconductors and infrastructure. Third, de-dollarization trends have central banks buying gold in size. Fourth, supply is tight. New mines are slow, so supply growth lags demand. All of that is conditional. A China property or policy shock can break it, and if AI investment cools, copper demand can fade too. As an investor, respect the supercycle possibility and keep watching China data, policy headlines, and supply shocks. Read the long-term trend on the chart, then adjust positions flexibly as live macro signals change. Commodity trading carries high leverage and high volatility. Futures can wipe out principal, and geopolitics or supply shocks can move prices 10 to 20% or more in a day. Even without leverage, swings of tens of % over a few days are common. The U.S. is both a major producer and a major consumer, so a Strait of Hormuz blockage or similar supply shock can still send oil and pump prices sharply higher in a short window. In the 2003 Iraq War, the 2008 crisis, and the 2022 Russia-Ukraine war, Crude moved 50% or more. Historically, those episodes have pushed inflation up by a percentage point or more in a single month, forced rapid Fed rate hikes, and knocked equities and housing 15 to 30%, including deep drawdowns in the S&P 500. This lecture is for education only. It is not a specific stock tip or an invitation to invest. Investment decisions are always your responsibility, based on your own risk rules and judgment. In the next lesson, we'll cover practical techniques for trading commodities on live TradingView charts. Thank you.